Welcome to the weekly Saturday knowledge sharing webinar organized by Meta and Meta. Thanks. Our today's topic is IPO on main board part 2. Friends, as you know, this is a ICDR series started by Meta and Meta. Last week we had IPO on main board where we discussed all the pre-IPO issues and compliances. Today we are going to discuss actual IPO, and today's our panelists are Mr. Samir Purohit and Mr. Rupesh Khan. Mr. Samir Purohit, Executive Director, MAFCOM Capital Markets Limited. Mr. Rupesh Khan, Executive Director, MAFCOM Capital Markets Private Limited. Limited. Welcome both of you. Thanks for your time. To formally introduce, Mr. Samir Purohit is an accomplished investment banker with over 19 years of experience in client coverage, execution, and syndication. He serves as Executive Director at MAFCOM Capital Markets Limited, a SEBI registered Category 1 merchant banker, and is also the founder and Executive Director of Yoki, an IFSCA registered investment bank, a qualified company secretary and law graduate, proud for CS professional. He has successfully handled 100 plus fundraising transactions across diverse instruments. He has also played a key role in shaping the regulatory framework at GIFT City and is a part of IFSCA committee for drafting capital market regulation. Welcome, Mr. Samir. Thanks a lot for your time.
Thank you, ma'am.
Our another panelist is Mr. Rupesh Khan. Mr. Rupesh Khan is a seasoned investment banking professional with extensive expertise in client coverage, execution, and syndication. He is Executive Director at MAFCOM Capital Markets Limited and founder and Executive Director at Yoki. A chartered accountant with a BCom degree, he has led 125 plus fundraising transactions across various instruments. He is also a member of SEBI Advisory Committee on SM REITs, contributing to the development and implementation of regulatory frameworks in this space. Welcome, Mr. Rupesh. Thanks for your time. Friends, you can see the CA and CS, what they can create together when they come together. And today we have majority CA and CS only as our participants. So friends, they both are our professional colleagues. So we welcome with wholehearted to both of you. Our today's presenter is Ms. Kinjal Mehta. Kinjal Mehta is a chartered accountant and a company secretary. She previously gained experience in EY assurance, auditing prominent private sector banks, and contributed to M&A transaction within EY's strategy and transaction advisory team. She also worked in Black Soil Capital, a venture debt fund underwriting investments in growth companies. Currently, she serves as a senior associate in Meta's IPO team. As usual, our moderator is Mr. Bala, Professor Bala. We call him Bala only. He don't need any introduction. And as usual, our own Sudhakar Saraswatullah is there. Welcome, Mr. Bala and Sudhakar. I'll request our panelist, Mr. Samir and Rupesh, to say a few words on the topic. Then Mr. Sudhakar and Mr. Bala, and then Kinjal, you can start. Over to you. Thank you. Yeah, Mr. Samir.
Thank you, ma'am. And thank you everyone for having us. I think the key point which missed in the profile is which I would like to cover here. So for reference of everyone, me, Rupesh, we are all part of ICICI Securities. So all these 19-20 years have worked across a combined experience of ICICI Securities, Motilal, Equirus, and I have worked in Cyril Amachal Mangaldas in the capital markets team as well. So I think that was the key messaging which was missed in the profile.
Okay.
So this will help as a context to everyone with respect to our background here. So just to quickly tell you about us, we as you saw in our profiles, about 2 decades we have been working in this merchant banking space and led multiple transactions, both of us. And this is not only IPOs, REITs, in which the first REIT InvIT in India, even the latest one, the SM REIT first and SM REIT in India. So there are multiple things like this, but that's how, after so many years of working, it was only 1.5 years back when we thought that we should set up something of our own, and that's how we came in this domain. So last 1.5 year, we have been building up a team, and we are there. So you will be hearing a lot about us this year. We have multiple launches slated for this year. We got, I think, almost 8 to 10 approvals on documents. So we
Great.
focus on mid-size main board IPOs and IFCA. It's the gift city. You guys already have heard about IFCA so much. We have been very instrumental since our ICICI days in GIFSCA. And as of today, we might be the most active banker in the IFCA market. So we are about to file two IPO documents in IFCA. So these are, and we are already working on dollar denominated bond raises in IFCA. So in a nutshell, we are working with issuers in IFCA side. We are working with issuers from no issuer from India, but these are all issuers from abroad like Sri Lanka, Dubai, Moscow, Vietnam, Bhutan, and Sri Lanka. So this is like in a nutshell about us, and more than happy if anyone has any questions about our experience. But I think let's move ahead with the presentation.
Thank you. Thank you. Yeah, Mr. Rupesh?
Yeah, hi, ma'am. So I think the introduction has already been given by Samir. So just to kind of just add, see, we all have a core investment banking experience. Last 15-20 years, we are into fundraising exercise, and India is a growing kind of economy. For next 5 years, you will see a tremendous amount of fundraising, and we want to remain active in this space for some period of time. And of course it's a wide and broad economy, right? So we are hoping that we all do very well, and that's why we started this entrepreneurship and guiding all the kind of people who are associated around us and in the ecosystem. Okay,
Thank you.
thank you.
Thank you. Thanks a lot. Yes, Sudhakar, few words, and Mr. Bala, few words, and then we
Yeah,
start
no,
at
no,
the
this
early.
is the second part of IPO, and already last week I had given my introductory remarks, so I don't have anything to add further. And while the presentation is there, and when I have to pitch in, I will do that. Bala, you
Thanks.
may take over.
Yeah, quick word.
Good morning to all of you. I have a great pleasure in welcoming you all on my own behalf and also on behalf of Mehta and Mehta. And really speaking, this topic is the well-known topic since both the panelists who are actually very excellent experience. Samir being our own company secretary professional who has turned a full-time merchant banking activity that shows, the company secretary's role, what he can play actually in this, which shows very much of the importance since he is coming with a lot of experiences. I'm very sure he will be sharing his personal experiences. And today I'm really, really privileged to see our panelists are CS and CA. Our presenter is also a CA. And we also have other stalwart CS, all those people are there. I think definitely this session is going to be very, very beautiful. I don't want to make much of a time in introducing anything on this beyond this. Let us start with the presentation. Let us hear from the expert panelists and hear from their personal experiences. I always believe the wise people learn from others' experience. That is what I'm looking forward today. I hope same is the case with the other participants as well. Over to Kinjal, please.
Yes. Good morning, everyone. Just give me a minute.
Kinjal, your voice is little echoing, huh? Just
Can you hear me now?
yeah.
Right. So good morning, everyone. As you know, we have a series for the ICDR compliances for a company. So keeping that in mind, we already completed our first session on mainboard IPO last Saturday. So this Saturday, it's more of a continuation, and we will look into other aspects of IPO on the main board. So today, what we'll be covering is the book building process, price band mechanism, anchor investors, how that functions, investor categories and reservations for the issue, subscription allotment, listing timeline, ASBA UPI application mechanism, post-listing obligations under LODR, Companies Act, IPO provisions, SEBI powers when it comes to the entire process, and we look into major, case studies of IPOs that have led the country to evolve its regulation to come to the point where we are today. So we had already discussed the book building. We had already discussed book building last time. So in continuation of that, book building is done in two manner. Sorry, the issue can be undertaken in two manners through book building that looks at price discovery mechanism and a fixed price issue. 95% plus of main board IPOs, most of them, almost all of them, come through the book built issue. A fixed price issue is almost irrelevant today, but we'll still look at both of them. So, under the book building method, price discovery takes place, and it's more of a market driven process to determine the fair value of shares during an IPO instead of fixing the price arbitrarily. Firstly, a price band is set. The issuer, in consultation with merchant bankers, sets a price band which has a floor price, which is minimum, and a cap price. And this is disclosed in the offer document, which is filed with SEBI. Then bids are collected, and during the bidding process, investors, be it QIB, NIIs, retail investors, submit their bids. And then the shares are and they specify the quantity of shares and the price band. The price band is not randomly chosen, but it's more strategic and data backed. And it is determined by the issuer and its merchant bankers. And it starts with the valuation of the company. So merchant bankers first arrive at a fair value estimate through relative valuation with looking at metrics with similar kind of IPOs. Other valuation methodologies such as DCF, discounted cash flow method, any kind of comparison with recent transactions, various investor feedback that they get. Merchant bankers conduct investor meetings and sound institutional investors about this particular IPO that they are looking to come out with. And then after all of these discussions and all of these processes, they decide a midpoint, which is an indicative fair value, and create a price band around it. Now the minimum now there is a floor price to cap price for a price band. So the maximum spread between the two is 20% of the floor price, and minimum spread is 5% of the floor price. Once this is decided, there's a bidding period of 3 to 10 days, which is used by investors to put in their bids. And just in case, if the BRLMs and the company feel that they got the price band wrong, and there needs to be a change in the price band, then they can do so. But if they do so, then the bidding period can be extended by 3 days. Once the bidding process is done, a final cutoff price is determined, and RIIs are bidding at this cutoff price, which is determined through this price discovery process. And then anchor investors are allocated this one day before the issue opens at an anchor price within the band. And QIB, if the issue is through QIB, then 75% of the net offer must go to QIBs. And if this is not subscribed, then there is a full refund that is required for the issue. And if under QIB, again 100% underwriting is required, and not so much if the issue is not through QIB. Coming to the fixed price issue,
One minute.
again,
Kinjal. I think panelist, if you want to add something to this, then she will move to fixed price.
Yeah, ma'am. So I'll just help while you have summarized on the theory, Kendall. In a nutshell, for everyone's reference, how the book is built. See, everyone knows that there's a DRHP which is filed. It is since that day, in fact, on the back end, what starts is, see, everything doesn't get built on the date of when the IPO opens. We start, we make a presentation, a roadshow presentation, we start reaching out to the investors. So this is how we start gauging interest. So it's a process of almost, so whenever an IPO is launched, at least 2 to 3 months in advance is a full marketing exercise, how we gauge the interest of the investors, the valuation is arrived at, negotiations happen, and so this is the entire process which goes through. Anchor is something, so QIB is an anchor. Basically, the idea of having an anchor is to have certainty of the issue. We cannot keep it open and see, just for an example, 1,000 crore IPO or even a 500 or even a larger IPO. You cannot keep the entire book open. So you need to be sure that there are some X number of investors who are going to participate in the issue. Regulations allow up to 50%, 60% QIB of the QIB portion. So there is a 6-1 and a 6-2 issue. You guys would have read something. So in a 6-1 issue, which is ICDR 6-1 and 6-2, 50% is QIB, and a 6-2 issue is 75% QIB. Of that 50%, or of that 75%, 60% can come as anchor. The endeavor is to fill that entire anchor book. Interestingly, very interestingly, lately, last couple of months, we have seen where people have also not filled in the entire book of anchor and went ahead with the retail and HNI subscription again. So this is very interesting, which we have seen in the capital markets in the last few months only. Earlier we never used to see that people are not filling the entire anchor book. So in a nutshell, just wanted to summarize this from a practical perspective. When we are deciding or when we are talking about so many things now, it is like 2 3 months of rigor, hard work along with the company. There are many participants. We will not get into that, but at least that that's how the price is arrived at. That's how the price band is arrived at. So that's how we get to know that how the price, which price we are supposed to launch the issue.
Coming to the fixed price issue, I'll just run through this. So, fixed price price is fixed and disclosed in the prospectus before opening of the issue. Investors know exactly what price they are applying. There is no price discovery that happens if the issuer bears the risk of mispricing. So, if it is overpriced, underpriced, and if it's not subscribed completely, then it's the entire risk of the issuer. Then 50% is reserved for QIBs and NIIs, and 50% for retail investors. All investors apply at a fixed price, and there's no cutoff option. Rarely used, like I mentioned, it's rarely used today. And the application money for this kind of an issue is block paid. Coming to the price band mechanism. So, like I mentioned, through the book building process, we come to a price band through which the price is fixed for the IPO. So there is a minimum spread requirement of 5% of floor price, which is mandated. So gap must be at least 105% of the floor. So again, this kind of requirement is to ensure that there is a a good space between the floor price and the cap price. Many a times, the issuer would put in a price band which is, say, 100 rupees and 102 rupees, which it gave like an artificially narrow price band, and did not have real price discovery benefit. Then you have a maximum spread requirement, so which says that the cap cannot exceed 120% of the floor price. So if the floor price is 100 rupees, a cap cannot be more than 120 rupees. So there is how much minimum spread you can go, and how much maximum spread you can go when it comes to the price band when the issue is getting listed. Now, during the issue, like I mentioned, if the price band is revised after announcements, where through the discovery process, if the BRL and company realize that maybe they have mispriced this a little bit. Maybe if they have priced it higher, then the issue may not be completely subscribed, and if they have priced it lower, then may not be able to raise more funds. So if they decide to kind of change the price band, then the bidding period is extended by 3 additional working days. There is so retail individual investors will bid at cutoff price, which is the price at which the issue gets listed. So if the retail investor, there is no risk that if they bid at a lower price, then they may not be allotted the shares. It's the cutoff price, meaning they will pay the price at which the actual price of the issue has been decided. So it allows for maximum allotment probability. Whereas QIBs and NIIs cannot bid at this cutoff price. Now, this is there because QIBs and NIIs are the people that actually contribute towards the price discovery process.
Rashmikant is actually asking, how do you actually find the anchor investor? Samir, would you like to address this?
Yeah, sir. Let me just kind of explain, sir, that the anchor investor is something who are like kind of intelligent investors, right? All the mutual funds, insurance companies, foreign portfolio investors, sovereign funds, or even a global funds, right? These are all the kind of people who kind of typically come in as a kind of anchor investor. That is for a larger transaction. Smaller transactions, there are other kind of category of QIBs also do participate, like AIF, alternate investment funds also. So if you look at how we identify the investor is after filing the DRHP, after 1 month or so, right? We kind of showcase the presentation and company story to these large institutional investors. They digest the story, they ask various questions, etc., around the business model, around the growth prospects of the company, etc. And if something which they convince themselves that okay, from next 3 to 5 years perspective, it is very good investment for the funds or for that particular investor, and they see a merit in the company story, they do give the commitment of participating in the transaction. So how it works is that the large funds, they wanted to have a certain minimum stake in the company on a post offer basis, right? So they decide the quantum, 100 crore, 200 crore, 500 crore, that depends. So they do come in as an anchor, they do also participate in the QIB as well, right? So everything is dependent on how the company story, how the company's business model and scale going to be. Historically is historical, but future is something which they all take a decision. And again, there are a lot of iterations and negotiation do happen during this issue opening period and between DRHP filing and issue opening period, right? And based on that convictions and demand book, we decide to file the RHP with ROC and open the issue. Samir, you want to add anything additional? Yeah.
Yeah, quick two things. So basically, after so many years of experience, we all have a sense. So as Rupesh mentioned, once we file the DRSP, we have a sense that which kind of pool of investors we should be reaching out to. There is an entire universe, but we have a sense that okay, this is a bucket of investors, or this is the strategy which we would like to adopt in a particular IPO. So, so that is a strategy which we finalize. We pitch it only to those pool of investors, and that's how we identify the anchor investors. And then that negotiation, as Rupesh mentioned, that is a process which the back and forth happens.
Yeah, Kinjal.
Yes, go ahead, Kenjal.
So that was a good segue into our next slide on anchor investors. Now, anchor investor is one of the more important investors in the IPO process. And it was introduced to provide a pre-IPO price anchoring and signal in confidence in the IPO. So so in anchor investors are a subset of QIBs. So all anchor investors are QIBs, and promoters, directors, and their immediate relatives are specifically excluded from being anchor investors. They have a minimum application size of 10 crore per anchor investor, and they get an allocation of up to 60%. So we will look into the allocation of the issue a little later, but the idea being that 50% of the issue is allocated to QIBs, 60% of this 50% of the QIB portion is allocated to anchor investors, and of this, one third is reserved for domestic mutual funds. And anchor investors apply one day before the issue opening, and the BRLM conducts discretionary allocation among the applicants for this anchor investor. The BRLMs decide which anchor gets how much, and it's not proportionate or automatic when it comes to allocation to anchor investors. Now, when deciding anchor investors, we're looking at investor quality, long-term, short-term orientation of these investors, and their credibility in the market. They have a lock-in of 50% of anchor investor shares that are locked in for 30 days from allotment, and remaining are locked in for 90 days from allotment. And all in all, the anchor investor allocation creates a visible signal of institutional confidence, which then significantly influences retail and NII participation in the issue, and kind of looks into how successful the potential success of an IPO. Now, again, this is not written in stone, in the sense that there may be cases where anchor investors cannot save an IPO as such, or cannot be completely relied upon when it comes to the success of an IPO. One exception be one of this outliers for this particular case being the Hyundai Motor India IPO, where there was an anchor allocation that took place, and there were premium anchors like LIC, Goldman Sachs, Nomura, Morgan Stanley, HDFC Mutual Fund, SBI Mutual Fund, Kotak Mutual Fund. And even though this particular IPO had marquee anchor roster, overall IPO was subscribed 2.37 times, but retail portion was undersubscribed at 0.5 times. And so the anchors did not substantially catalyze the retail participation in the IPO. And so the stock debuted at like a discount, and continued to underperform post listing. And one of the things that was an issue with this IPO was the valuation. There was a concern with the valuation and the OFS structure of this issue. And so this kind of is an indication that, even though anchor investors are extremely important in the process, and they are the ones that signal the success of an IPO, that may not always be the case.
So I just want to kind of add here. So how it works? Say suppose say in Hyundai Motors, right? So there are QIBs which participated strongly in the transactions. HNI, of course, there was no great response, and even retail, there was like kind of very thin response. So how it works basically, the people who are committed to kind of stay invested for long period of time, so who are all those categories? Those are like QIBs only, because they are not looking for short-term loss or short-term gain. They are looking for long-term gain. They want to stay invested in the company for long-term period. HNI and retail are more of a opportunist, I would say. Why? Because if they see a good amount of gain, they will just kind of flip the stock. If they see a big amount of loss, then also they they cut the loss. So they are not a long term. Those money are not a long term money. Those it's a like very short term or opportunist kind of a category of people. and that's why the reliance would be little less in the IPO kind of transaction where there is a discovery and all. On post listing basis, to naturally based on the story, based on the research, based on the kind of guidance from various intelligent people, including brokers, people do participate. Everything is dependent on the your capability to hold your investment for long term period, and that is what the determinant for your determinant to participate in the transactions, and to what extent you require to participate. So that is how the investor look at it, and that is how the market works.
Coming to various investor categories and how the issue is allocated between these different types of investors. So ICDR provides for how the allocation for the issue takes place. So all in all, the issue is split into QIBs, NIIs, retail, and others. So QIBs take 50%, have an allocation of 50% of, like I mentioned, of this 50%. Um, uh, fa- um, 60% are anchor investors of the QIB portion. And then you have the small NIIs that get one third of the NII quota. NII
Angel,
quota being
Angel, I will
50.
request give full form. Some people may not get idea. So BRLN, QIB and all that. It looks sound basic, but there are many people who are having. So please give full form once at least. Okay.
So
Kinjal also check your audio. At times, what happens, we actually get, the voice is breaking. Whether it's
can you hear me now?
Yeah.
now it is
Yeah, yeah.
perfect. But sometime it happens.
Yeah.
Go ahead.
Okay. So QIBs being the qualified institutional buyers, these like our panelists mentioned, these are institutional investors that invest in the IPO. NIIs being the non-institutional investors, these are high net worth individuals, trusts, etc., that are not institutional investors as such, but they also invest heavily in the IPO. So the allocation for such non-institutional investors or NIIs is 15%. Now, this 15% is split between small and big NIIs. Um, this we will look into a little later. This has been a relatively recent change that has taken place. And coming to retail investors, retail individual investors or RII, they have an allocation of 35% of the net offer. And then there's a reservation that's allowed for eligible employees and shareholders of the subsidiaries of the company. And eligible employees could include current ex-employees, including ESOP holders. And maximum reservation can be up to 5% of post-issue paid-up capital. And they have an application limit of around 5 lakhs. And they can bid at the cutoff price. And shareholders of listed companies, as of other listed subsidiaries of the company, then the shareholders of such companies may also be provided allocation under the IPO. If there's any shortfall in these reserved categories, then they spill over to the net offer to public in proportion to their respective allocation. Now, like I mentioned, there are small non-institutional investors and big non-institutional investors. This was split only recently. So, in April 2022, where before April 2022, there was just one single bucket of 15% allocation to non-institutional investors. Then there were very large applicants under this category of 5 to 10 crores. And they were usually leveraged. They would borrow and invest in various issues. And then you had the smaller HNIs who would invest around 2 to 10 lakhs, who would get crowded out. They would not be receiving allotments under this particular category. So then allotment tended to behave like a lottery at high over subscription, and smaller applicants, had almost no realistic chance of getting allotment. So then SEBI came up with this split where there was small non-institutional investors and big non-institutional investors. So small non-institutional investors have an application size of 2 to 10 lakhs. And they get allocated one third of the NII quota. So one third of the 15% total NII quota, which is 5% of the issue. And then you have the big NIIs, whose application size was above 10 lakhs, and they get an allocation of two-thirds of the NII quota, or 10% of the entire issue size. Coming to subscription allotment and timeline for allotment. So, like we went through the process for the bidding and book building. It's open for minimum 3 working days, 3 to 10 working days. In like I mentioned, in case of price band revision, extension of 3 working days is allowed. And there are such you have the timeline for this particular bidding process. And if through this bidding process, the IPO does not reach minimum 90% of subscription of the total offer size, then the entire issue fails and all application money should be refunded within 15 days of issue closure. And in case the company is not able to refund this money, then an interest of 15% per annum is charged from the 16th day. If the IPO is through the QIB route, and if 75% of the if the issue is not allotted to QIB, then full refund is required to be made, regardless if the issue is completely subscribed in other categories. The issue also requires minimum 1,000 allottees, and ASBA and UPI facility is required, and it is unblocked in case the issue fails.
Kaushik would like to know actually how the allotment process done in practical. Lottery kind of a method or anything else?
It is completely discretion of the BRLM and the company. So basically, when we say discretion, so we pick and choose, and that's what everyone wants. So this is a very sweet spot where every company and a BRLM try to maximize their discretion here. QIB and retail and HNI. So retail and HNI portions, basically here these are discretionary or the draw of lots in case of retail. It's not discretionary. So basically it's not within your hands that you can decide that you can allot to someone or the other. So that is something which is all depend on oversubscription in the issue. It's only the anchor piece practically which is in a complete discretion in the, but anything which comes in those 3 days, it is all how the book is built. So if someone comes and, so just for an example, you have 1,000 crore IPO and there's an application of 1,000 crore by one person, or completely 18% you have not spoken to. There are people, so there are different kind of investors in the market. People who like to flip in, like, say shortest on the date of listing or within 10 days of listing. So they give very high bids. There are hedge funds in the market who don't want to stay. Their investment philosophy is to, have a very short-term investments. So that's the kind of, the discretion or the non-discretionary piece which can speak about. Sorry, Bala sir.
Yeah.
Sorry, Bala sir. The earlier point, which I think the earlier slide. So just wanted to add 2 cents here. So for everyone's reference, at least I hardly recollect personally, apart from 1 or 2 instances where a payment of interest has happened. See, whenever in Indian capital markets, whenever if there is not an issue or there is some lack of subscription, if you get that sense that for whatever reason you will not be able to touch 90%, then in that case they will withdraw the issue. for whatever reason. However, we have seen one or two exceptions, because in one of the cases we remember it happened about 1 or 2 years back. Uh, After the money came into the account, there was a SEBI inquiry, and the money has been held in escrow till now. In fact, as far as I remember. In the other case, you guys would have seen, there was a big corporate. For some reason, the IPO concluded, and the money was refunded back. So these are very sparse or very limited, or not even limited. In fact, okay, you will find that the IPO has not gone through, and there's a payment of interest. So this is more, because it's a very big issue for the company, very big issue for even the merchant banker to not get it subscribed. So that's a practical perspective which we are sharing here.
Akhilesh wants to know actually relative of a director or promoter having a venture capital company. Can they invest in the director promoter IPO
No.
as an anchor investment?
No.
The beauty about SEBI is, we all read ICD here. This is one principal regulator which will see, in SEBI or in capital markets in India, you have to follow the book as well as you have to follow the spirit. So when we are exercising discretion from an insider trading point of view, because we know all the insights, the promoter's family will be knowing all the insights. So giving to them will tantamount. So even if whatever the regulation says will tantamount to kind of a breach of trust situation with the other guys. So if you say, obviously regulations also don't allow, but at the same time, what will happen is, even no one does this, because if an inquiry happens, then this may tantamount to a breach of trust, and this will not be taken very seriously with the regulators. Sorry, this will be taken very seriously with the regulators.
No, you are actually right, because what happens is most of the scams and other thing what we have witnessed in India, these are all happen through the route of the related party transactions. That is the main issue. That is why
Yes,
SEBI.
So I think, sir, the most important thing what you need to understand, right? I think the question is very much valid. So, what is the definition of relative? Relative is a one is a something which is a RPT as per the Ind-AS or accounting standards, right? If someone is not falling into that category, right, and someone is having their own funds, now relative could be a distant relative also, right? If that would be the case, then naturally they can participate in a kind of a anchor. But at the same point in time, the spirit, and there should not be any kind of shuffling of the transactions or routing of the funds, etc. Those is something which is not allowed. It should be very very independent call end of the day, right? So that is what something which is important. Second is a promoter and promoter group concept. If someone is a maybe a distant relative, but it doesn't fall in the category of promoter and promoter group. So promoter and promoter group is someone who is not allowed to participate in IPO, because that is not classified as a public for all practical purpose. And that's why the disclosure, if you see in the DRHP, whether someone is holding the shares or not holding the shares, we are required or bound to make the disclosure that who are all the people who have been classified as a promoter and promoter group both. Even the company who has no relation with the company, though it may be disclosed as a promoter group, so in future if they invest in the company or buy the shares, the shares should be classified or categorized as a promoter group holding, because they may have the privy of insider knowledge or insider trading regulations. All these things would kick in after the listing.
Somebody is actually questioning about the IPO. He says cost of the equity is higher than the cost of the debt. Cost of the debt being the interest as a tax deductible expenses, while the equity shareholders get the dividend after corporate tax. As a cost of equity is higher than the cost of the debt, why the companies actually go for the IPO instead of borrowing from the banks?
Very simple, sir. Company cannot able to increase their borrowing limits in absence of the company's balance sheet strength. So if you really want to borrow more capital, right, for the purpose of expansion or working capital, you require to strengthen the balance sheet, which will be in form of equity. So someone required to contribute equity. Now, in absence of equity, naturally promoter is fully invested. We presume the always the same way, right? They are fully invested. They doesn't have extra capital for the growth of the company. In that situation, sir, you require to take the help of the public money to kind of do the faster growth. Now, growth is in a two way. You can do the subscription, or you can arrange money after 3 years, not today. But you require a capital today. So in that case, you have to take support of transactions like private equity, private placement, or I would say public issue.
I would, sorry, I will just make it more simpler uh, and just try to answer it in a different manner. So, 2 points again, as Rupesh mentioned, you need to have a optimum combination of equity and debt. That is one thing which he also covered. That is very precise. Second is simple valuations. जो इसने second part of the discussion में मतलब Rupesh mentioned. In a nutshell, see whatever pat you get or whatever numbers you get, whenever you get a valuation equity का वो एक multiple होता है 10 times 20 times 30 times आपने देखा होगा P multiple of so and so. डेट में आपको कुछ नहीं मिलने वाला है. So when you go into IPO, the story is multiplying, right? That's why if you would have seen very large corporations, just for an example, Swiggy, Zomato's, Paytms, or any large corporations or any unicorns which are happening, when they hit the IPO, unka, though they are promoters or who founders who started the company, but unka stake hoga hardly 5, 10, 15%. But the valuation of that 10, 15% will be thousands of crores. So that is the multiplier effect, basically, in a nutshell, to answer that query. So it's not only cost of debt. You cannot be very cautious every time.
Thank you. Mr. Pankaj, you are satisfied. Now we are talking in English. One of the participants says that let it be in English. So Mr. Samir has accepted. Immediately.
Somebody has actually quoted Infosys did not reach the 90%, then the Narayan Swami sought and got the help. This case study will help. When you are talking the 90% subscription and interest refund, I think that connection he has written, I think.
Yeah.
Yeah, correct.
Yeah. That is
I
the
think
correct.
I think one of the point which I just also wanted to just throw some light. What is the underwriting? Okay. So underwriting in Indian context, okay. So there are two things. Underwriting is something which, if no one is subscribing, then the merchant banker or investment banker who has taken a responsibility to raise capital, they themselves required to fulfill that gap, which is a shortfall. Okay. Because end of the day, the price, something which is been determined for the purpose of fundraising, is been determined with the help of investment banker or merchant banker in consultation with the company, because end of the day, promoter is the one who is getting diluted, so it has to be in consultation with the company. Now in US, the underwriting is something where the fees of underwriting is very high. It's like kind of 5 to 7% kind of range. Why? Because there is a skin in the game for investment banker, and that's why the fee is very high. Like for example, if you look at a Facebook transaction happened at XYZ price, 36 rupees or around 40 rupees. Then after it fell to kind of 15 kind of dollar. Sorry, it's a dollar term, 36 to $40, and then it fell down to 15 or $20, right? End of the day, who took those kind of exposure? It's an investment banker or investor, which is been arranged by the investment banker, right? But that is a conscious decision, and they make a lot of money. But in India, that doesn't work that way. Okay, here the fees of the merchant banker or investment banker is not that high as you see in the overseas market. Here the underwriting agreement do get signed when the issue get closed. That means 100%, 90%, minimum 90% of the fresh issue is getting subscribed, or 25% or 10% equity getting diluted. So it is getting signed on the date of closure of the issue. That means there is no subscription risk that banker is taking. In case if there is any shortfall, which now there is a application supported by blocked amount, that means your amount is getting blocked. You cannot withdraw the application for all practical purpose. Particularly QIB and NRI cannot withdraw the application, but retail can do that, right, by writing a email to say registrar or so. But in retail also, there is an application supported by blocked amount concept works, where your amount is getting blocked. So technically, and practically there is no risk of reducing the subscription level after issue closure, right? So in that situation, I would say there is no risk of underwriting. So it is called a soft underwriting for all practical purpose, right? So there is no hard underwriting. But in SME transaction, which is a small and medium IPO, and there is a separate regulations given by SEBI. In that, there is a hard underwriting to happen, and in that, you are bound to kind of subscribe fully. So that is what the underwriting concept is here.
Yeah, thanks. You explained very well about the Anup Sharma's question. Please explain the underwriting concept. There is someone else actually asking a question. Did not get the allotment in case of the oversubscription 4-5 times. Some got allotted, some did not. What is the process actually followed?
Sorry, come again,
Probably-
sir, the question. Sorry, I didn't get the question.
He says, did not get an allotment in case of the oversubscription 4-5 times.
Yeah.
Some get allotted and some did not get allotted.
Yeah.
So what is the process follows? He wants to know practically from it.
So basically, sir, it's a lottery system. Lottery system is again, it is like again an automated system, right? So basically, the minimum application amount is say 15,000, and it can go up to 2,000, right? So each bucket, right? Every lot. So suppose in IPO, if there are 10 lots, okay. So if you apply 10 lots, then application amount will be 2 lakhs, and if you apply 1 lot, then application amount would be say 15,000 rupees, right? Now in this situation, what happens is, if you look at proportionate basis, how the number of application that we received in each of the bucket, right? Now in India, practically majority 95% of the application that we receive in the IPO will be a minimum kind of application size, which is 15,000. Now the rules is designed in such a way that any investor who get allotment of shares in the retail category, one lot is mandatory to be allotted for all practical purpose. So 95% of the procurement will be of minimum application size. Now, if I receive 1 lakh applications, right, and if I am allowed to make a allotment only to 20,000 applications, right, because that is the only quota that is available. So every 5 application, 1 application will get selected. Now how it works is there is a random number, okay. There is any 5 random number out of 100, sorry, out of any 20 number out of 100 will get selected. Those random number is something which is called lottery, right? And that is something which is nowadays people use a technology that you choose any 20 number out of 100. Those 20 number applications where you get the allotment, remaining 80 will get refund. So that is what the lottery system is.
I think, Kinjal, it is 12 o'clock. Let us complete the presentation, then we'll take up the questions. Because
Absolutely,
otherwise,
yeah.
I don't think your presentation will not go through.
Once the bidding closes, and the issue closes, we'll just go through the timeline of what happens. So on day T is when the issue closes, which is the last day of bidding subscription. Bid data is locked at exchange level, and then no further applications or modifications are accepted. And once that is done, the next day bid data is downloaded from exchanges, and the SEB, which are the banks, and depository, they their data is reconciled in terms of shares allotment versus amounts received. And any kind of technical rejections identified from the application, be it invalid bank accounts, insufficient funds, etc., are rejected. And once all of this is done, then basis this allotment is prepared by the registrar and transfer agent. The next day, then how the shares are going to be allotted, the basis for which they are allotted is finalized by the RTA and submitted to the designated stock exchanges. Then the exchanges basically approves of this allotment, and allotment is made to all of these categories that are confirmed. Now, The next day, the shares are then credited to the demat accounts of these allottees, and ASBA UPI funds are unblocked for the investors that did not get the shares allotted. And once this is done, the listing is commenced, trading begins, and on this day, and basically then the company is listed and all the requirements for listing, listed company, LODR, etc. becomes applicable.
Injure one small correction. These
Mhm.
T plus 1, T plus 2, T plus 3. Just this has to be ideally data validation is on T, basis finalized on T plus 1. Allotment is on allotment also on T plus 1. Credit of shares would be T plus 2. And
Okay, so is
listing
it
would
T
happen
plus
on T
2,
plus
T
3.
plus
Yes.
3?
Yeah.
Okay, okay.
So it's a
Yeah,
one
yeah.
day
So T
before.
plus,
All these things
yeah.
is one day before. Yeah.
See, T plus one, so it happens many times. It's a very concise and a very short duration. So it may happen spillover in the late night. So technically, so we all endeavor that we complete everything on T plus one so that early morning the credit happens on T plus two so that we don't drag it. And so that by end of T plus two, we get the listing approval. And the next day, the listing happens, the T plus three.
We have to ensure that on T plus 2, all the shares do get credited in the demat of the investors.
So
That's
this is a practical, so this is what we mention is the practical aspect. What you have written is absolutely fine, but this is
absolutely.
more of a practical approach which everyone takes in all issues.
So that means practically behind the show, everything happens within a day,
Yes, yes, sir.
well before 24 hours,
That's
so
correct.
that ultimately it reflects the T plus 2 in reality when we actually look at the paper. Otherwise,
Correct, sir.
everything practically happens within a day.
Correct, sir.
Yes, go ahead, Kajal.
Now coming to basis for allotment, category by category. So QIBs, excluding the anchor investors, with no discretion. All QIBs, other than anchor investors, receive shares on proportionate basis to their bid amount. Um, and multiple applications with the same PAN are treated as one. Coming to the non-institutional investors, small and big, there's a draw of lots that takes place if it's oversubscribed, like our panelists mentioned. If it is oversubscribed, every eligible applicant first receives one minimum lot by draw of lots, and the remaining shares are allotted proportionately. Then there is a single bidder per pan, like I mentioned. Uh, each pan is considered as one bid only, and if there are multiple bids, then multiple applications with same PAN are rejected. Then in the retail individual investors, like I mentioned, if it is oversubscribed, then each applicant receives minimum one lot by computerized draw, as we discussed. And if shares are insufficient for all applicants to get even one lot, lottery system is available. And all RIIs, like I mentioned, they apply at cutoff price. Coming to employee and listed subsidiaries, allotment within each reserved category is on proportionate basis, and unsubscribed portion in this reserve category spills over to the entire net offer, which is your QIBs, NIIs, and RIIs, and proportionate to their respective allocations. Coming to the ASBA and UPI application mechanics. So, when applying for
Ninja gave full form of everything, no? For everyone. Info.
So application, ASBA is application supported by application supported by blocked amount. So this essentially, it is ASBA is mandated application mechanism for all IPO investors. Under this ASBA, applicant authorizes the bank, which is the self-certified syndicate bank, SCSB, to block the bid amount in the bank account when the investor has applied for shares for an IPO. Funds from this account are not actually transferred out of the account at the time of application. They remain in investor's account and earn interest while being blocked against other withdrawals. Then once allotment takes place, only the amount corresponding to shares allotted is debited. So someone may have applied for 10 lots of shares, but so the amount that gets blocked is the amount for that 10 lot of shares. But if he gets allotted only 2 lots of shares, then only the amount related to these 2 lots is essentially debited. Excess blocked amounts are automatically unblocked. In case of non-allotment, the entire blocked amount is unblocked. Coming to the UPI mechanism, so from 2019, SEBI introduced UPI as an additional payment mechanism for retail investors for application value up to 5 lakhs. Investors submit their bid through a designated intermediary, which is a broker or a bank, citing their UPI ID. And the investor receives a UPI mandate request on their UPI app, which they must approve to block the funds. Now, SEBI has mandated a T+3 listing for UPI-based applications from November 2023. And UPI mechanism eliminates the need for physical forms for retail investors that are required under the ASBA method.
So just one point, anchor investors are always ASBA. So it's a physical application which comes in and the physical money gets transferred. So
Anchor is a
that's the,
non-ASBA. Sorry.
huh?
Anchor
Sorry.
is a Anchor is a non-ASBA.
Non-ASBA. Sorry. When we say non-ASBA, yeah, sorry. Non-ASBA. It's not blocking of amounts. Sorry, correct. Non-ASBA. So actual money transfers. And the other cases are blocked amounts, which are ASBA accounts. So that is the difference. Sorry, Kanjal, please go ahead.
So I will once the company is listed, there are immediately SEBI regulations that are applicable. One of the major ones being the SEBI LODR regulations. Be it regulation 17, 18, when the regulation 17 when it comes to board composition, which is required on a continuous basis once the listing is made. Then you have the audit committee composition, which is mandatory for all listed companies. Regulation 23, which is a related party transaction regulation, which is way more um, uh, codified and more stricter than the related party transaction requirements under Companies Act. Where all RPT transactions need to be approved by audit committee. There is requirement for material RPTs, shareholder approval for them, and a policy needs to be adopted for related party transaction. Disclosures need to be made, etc., etc. Then you have your regulation 29 for prior intimation of more less than if any kind of board meetings for financial results, dividend buybacks, right issue, bonus issue, then prior intimation to stock exchanges are required. Reg 30, one of the bigger regulations, where all material information which may affect the share prices when it comes to the company is to be disclosed to the stock exchange within 24 hours or 30 minutes of the market hours. And SEBI mandates certain events that need to be disclosed. And you have the part B, which is materiality wise disclosure, which is required. Then you have Reg 33 when it comes to financial results, quarterly standalone results, audited annual results, which are disclosed on the exchanges, websites, newspapers, secretarial audit requirement, website disclosures that are required. Um, etc., etc. So on the day once the company is listed, your entire LODR and several other SEBI regulations become applicable on the particular company.
Yeah,
Now,
sorry, Kinjal, just a point here for everyone's reference. While everything kicks in and gets applicable from the date of listing, so whenever you file a DRHP, so there is one of the regulations also. We need to, all the committees, everything needs to put in place at the time of DRHP itself. So
yes.
assuming that you are a listed company, whatever is applicable, you need to comply with, like the committees, independent formation of independent, having inducting independent directors and all such important ones. However, specifically these Reg 30 disclosure and all will kick in only once you list. But that's the nutshell, that you need to ensure that whatever, so like having those policies, the mandatory policies which typically a listed company has, you need to frame all of them. So everything needs to be in place beforehand. And this becomes a part of diligence also. So when the BSE, NSE, SEBI, we also as a part of our diligence, ensure that these things are really in place.
Right. Rightly pointed. Before also listing, you should be ready with the board composition and the policies at the time of year. Yeah.
So when the company files the DRHP, it becomes due to be listed, and requirements under LODR are also mentioned for companies that are due to be listed. That requires all of them to have the committees, the policies, everything in place before the actual listing.
Yeah, absolutely. Both of you are correct. Actually, one of the participants has also asked the question. Kaushik, company has filed actually DRHP, confidential offer document, and was received by SEBI observations for suggesting to changes in UDRHP. When the corporate governance, such as holding the audit committee with a gap of 120 days, then risk management committee 230 days, etc., is applicable immediately after NOC of the SEBI observation post listing. This is a question he has asked. You are well answered actually. Right from the day you decided to go for the listing, you should be prepared for everything. Your committee, you're identifying the independent director, composition, and all other thing. And as Kinjal puts it, the day listing started, each and every regulation compliance is actually called for right from the day one. It is not we can wait till the listing is done and after that we start doing the thing. The preparatory work is required to be done well in advance so that we are prepared to meet the compliance right from the day one. That is it. Very nicely you put it, Samir, and Kinjal also added to it. Yeah, go ahead.
So once the company raises funds, there is a mechanism that is put in place by SEBI to ensure that the funds are utilized for the goals that were mentioned in the prospectus and the offer document. So every rupee of the fresh issue proceeds is subject to monitoring until it's fully deployed as per the objectives in the offer document. Any kind of deviation, it becomes a regulatory event which requires shareholder approval, a filing with exchange, and a mention in the annual report. So now, if a fresh issue is over 100 crores, then a SEBI registered monitoring agency, which could be a credit rating agency or a public financial institution, must be appointed from the DRHP filing stage, and quarterly filings are made for utilization of such issue funds with the stock exchanges. Like I mentioned, in case of any kind of deviations, material deviations from the objects of the offer, you're required to make a special resolution um, with 75% public shareholder approval. Promoter does not get a vote in this, and a disclosure requirements to stock exchanges within 24 hours of such an event. And like I mentioned, commentary in the annual report. And BRLMs are also notified. Like I mentioned, there's a quarterly reporting that happens until the proceeds are fully deployed as per the objectives of the offer letter, where statement of utilized funds is filed with exchanges, and any kind of deviations are highlighted in this particular reporting. And the auditors also certify the utilization statement. And so there were times when the uh, the issue proceeds were used for general corporate purpose, and um, this um, this this particular amount could run up to a very large amount. So SEBI put in a cap of 35% of fresh issue proceeds or 100 crores, whichever is lower, which prevents issuers from parking large portions of IPO funds in undisclosed uses, where they just call it general corporate purpose and it is utilized for any random purpose, which is not allowed. And any kind of under deployment of funds under this category beyond 12 months must be explained. There are several key IPO provisions under Companies Act also, which is so Companies Act also looks into matters that are stated in the prospectus, and it is aligned with the ICDR when it comes to financial statement, audit report, risk factors, capital structure, objects, etc. It also specifies regulations for offer for sale, where there's compliance with respect to prospectus, and selling shareholders having identical liability as the issuer for accuracy of all statements of the offer document. Then it also looks into dematerialization of shares for the public offer, where all securities must be in demat form. And then registration of prospectus with the ROC. Then the requirement for 90% minimum subscription and refund if failure for this is also under Companies Act. It specifies civil liabilities for misstatements, criminal liabilities, any kind of fraudulent inducements. It also looks into allotment of securities under the issue. It also covers securities on stock exchanges, where listing application must be submitted before or simultaneously with the IPO opening, where
So
you
the
get
call
in
is
principle
getting
approval.
failed from.
So
Go
you get an
go
in
on.
principle approval from the exchanges for the particular issue. Then it also puts in place regulations for further issue, director disqualification, related party transactions, and fraud. Coming to the director's liability when it comes to an IPO, these are the the people who actually running the show when it comes to the operations and the governance of the company, and the directors take up a big liability when it comes to the prospectus, the offer document that is put out in public, and it is signed by all directors, where each director personally declares that every statement made in this prospectus is to the best of their ability, their knowledge, true and correct, and no material facts have been omitted. And this kind of creates an enforceable legal liability.
So,
So
Kindle, just to add here and give a very classic example, very recent, not recent, very recently, but about a couple of years back. So again, in practicality, we'll just wanted to club the director liability point, and you mentioned about the post-listing obligation of monitoring. So there is a very classic and a very big case, a large corporation. It happened about a couple of years back. Again, we don't see these situations very ordinarily. Like, see, you would have seen about thousands of IPOs, so these might be handful of them. But this was very remarkable case where they had mentioned one statement in the objects that the proceeds which come from the IPO, it will be used for OFS. Sorry, the office, it will be used to repay some debt of the group entity. For some reason, post listing, for some reason, it could not happen. So this was one remarkable example where the regulators ran after them. Everyone was put into question that why it did not happen, because the company had stated this. A classic example where you can also have this example as a director liability. Everyone was put into question. Everyone was liable that you made a statement and this did not happen. So even the monitoring was challenged that why it did not happen. So again, very few situations of this sort. typically, if it happens, they follow the Companies Act route of taking deviations and approvals. But however, there was a very remarkable case. We'll not name it, but it's a very remarkable case study which has happened, but very rare cases.
The core principle behind director liability being that directors are collectively and individually responsible to ensure that the IPO document contains true, fair, and adequate disclosure when it comes to a particular IPO issue. Now, under Section 35 of Companies Act, all persons who are authorized in the prospectus have joint and several liability, and compensation is payable to any investor who subscribe based on the untrue statement. So then, the only defense available in this particular case is that these directors bona fide believed that whatever was in the prospectus was the truth, and there was reasonable investigation that had taken place before such a statement was made in the prospectus. There is an expert opinion, external expert opinion, which has been relied on by the directors when making a statement. And then there is an issuer's representative that gave false information without the director's knowledge. So they didn't have knowledge that this particular information was actually false before it went into the prospectus. However, they are required to actually validate the information that goes into the prospectus before the prospectus is actually gone out.
I would
Then
seek
under
one clarification from both the panelists. One thing is there is this is all this IPO detail, etc. It's all signed by the director. It's all coming out. That is one thing. We are talking about not making a misstatement, etc. And other thing. But here there are two things which are coming to my mind. One is the company secretary. Company secretary is bound by ensure all the compliance under the Companies Act is required to be complied with. That is his responsibility, though he is not involved in this process directly. Second thing is CFO. CFO is the one who's actually responsible for all the financial figures, etc., which are actually being presented in this prospectus. In such a case, what is exactly the role of these two KMPs in the company?
So I'll go first. Very critical. See, once you sign a document, you cannot absolve yourself from any kind of liabilities which may arise here. Again, no doubt the directors are responsible, but directors, as a company secretary or a CFO of the company, you are also responsible for the information which has gone in. So, and a very critical role has to be played by both the professionals here, the company secretary and CFO. Very, very critical. In fact, they are the hub or the spoke, the main spoke here in the entire process. So, technically speaking, so just for an example, if there is a non-compliance and it has not been reported, obviously the director will hold internally the company secretary or the compliance officer responsible, and vice versa, even for the CFO. If there is something in the account, see, although we have auditors, we have taken confirmations from a PCS or a auditor, but eventually being an important KMP of the company, there is a huge amount of accountability even for those roles.
And not only that, as you rightly mentioned, PCS has to give several certificates for carry out due diligence as regards compliance. And it's a very important certificate to be taken by DRLM and the SEBI takes consider. And same way the valuation, the auditors has to work out, help a lot. So these two professions are very crucial for this entire IPO process, including drafting policy for CS and PCS, both constitution of board, committee, their composition, the policy drafting. It's very all crucial to be considered. Yeah.
Companies Act also puts in place criminal liability when it comes to misstatements in the prospectus, where it is believed that there was fraudulent inducing of investment that has happened through the prospectus. Then, in such a case, there is imprisonment of up to 10 years and or a fine. And this requires proof of fraud and intent to defraud um, when such a serious allegation has been made. Now, you under SEBI also puts comes hard on such on directors, where penalty can go up to 25 crores per violation, or 3x of any kind of unlawful gains that have been earned through such misstatements, misdirection in the prospectus, whichever is higher. SEBI can also initiate adjudication, monetary penalty. They can bar from capital markets, order disgorgement, refer criminal prosecutions, etc. Now, disclosure in offer documents does not shield independent directors. Any kind of misstatements in the prospectus that is approved at the board meeting, and if the independent director approves the prospectus as required under ICDR, they cannot then put their hands up saying they were not aware of certain things and disclosures that were made in the offer document. Then SEBI has several powers for any kind of mischief that takes place under this process. SEBI issues its show cause notice, which is their first step in enforcement. And when they have identified the alleged violation, and the company or the director have a right to be heard, and they will file a reply and request for a personal hearing before any kind of adjudication officer is put in place. Now, adjudication officer issues penalty orders once the violation has been identified and confirmed, and they can issue maximum penalty of 25 crores per violation of, or 3x of the unlawful gains made, whichever is higher. And these penalties accumulate per violation. And then under 11B, SEBI may pass directions, restraining orders, debarment from capital market, disgorgement of unlawful gains, impounding of assets, appointment of administrator can be done by SEBI in case it is thinks that there is some mischief that has taken place. Then the entity may approach SEBI to settle violations without admission of guilt, which means that the settlement amount is paid to SEBI, which may include any kind of disgorgement, interest, penalty that any kind of violation may have. Now, this settlement mechanism is essentially the company themselves going to SEBI admitting violations, and this kind of avoids prolonged litigation. It maintains confidentiality. It does not come out in public. So it's a quick fix essentially. Then any kind of appeal goes into Securities Appellate Tribunal, and orders are issued by SATs, and any kind of further appeal is to Supreme Court. Any kind of willful violations of the SEBI Act, in any kind of intent to defraud or induce investments can lead to imprisonment of up to 10 years and or fine. And this is separate from adjudication, and both of them actually can run simultaneously. Coming to common IPO violations, now this is where there is a major amount of mischief, either mischief that happens or mistakes that happen by the company when it comes to the IPO process. There is any kind of non-disclosure, inadequate disclosure of material information. There's kind of false statement in the offer document. There's market manipulation that takes place, which involves artificially inflating subscription figures through Benami or coordinated applications. You have price manipulations through circular trading to inflate secondary market price of IPO proceed, secondary market after the listing day. Then any kind of misutilization of IPO proceeds involving diverting fresh issue proceeds to promoter and related entities. any kind of violation of lock-in restrictions involving transferring the locked-in shares to through pledge invocation without disclosure. So in case the locked-in shares have been pledged, and any kind of invocation of this pledge that takes place, then it results into a violation. Then any kind of front running by BRLM employees who are trading on undisclosed IPO information, and any kind of failure to make timely disclosures under LODR post listing. These are majorly, areas where companies falter when it comes to the IPO process. We'll just look at some of the main IPOs that have come out in the recent past, that have with major highlights and how they have kind of shaped and evolved the regulations that are there for the IPO process today. So coming to the Zomato IPO, this was one of the IPOs that we discussed in our previous sessions also, where this was one of the major IPOs through QIB route. As we discussed last time, if the company is not profitable, they can and do not meet certain criteria, then they can opt for this QIB route, where Zomato was one of the bigger IPOs under this route. And it was a successful IPO that allowed the company to raise some 9,375 crores, of which 7,500 crores was fresh issue and 1,875 crores of offer for sale. And Zomato at this point had a net loss of 2,385 crores in FY21, and could not qualify under the profitability route, so they opted for the QIB route. The subscription was 51.8x. When it came to QIBs, NIIs was also oversubscribed, RI was also subscribed. Overall, the issue was 38.25x oversubscribed, putting in significant confidence in terms of the QIB route in the Indian markets. Post listing also it performed well, opening at 115 versus issue price of 76 rupees, with a 51% premium. And then it was, like I mentioned, one of the first major QIB route new age tech company IPOs. And it's one of the QIB success stories of an IPO in the Indian market today. Coming to Paytm, which there was a lot of issues that took place with this particular IPO. There was kind of a mismatch in terms of market expectation, pricing, narrative, and business model, in a sense. So Paytm again had cumulative losses of some 3,000 crores in financial year 1921, and revenue had been flat for 3 years. Yet it was valued at 26x, and with very, very high premium. This was because it was one of the poster child of India's digital boom, and by 2021, Paytm was everywhere. You had wallets, UPI, lending, commerce. It was backed by global investors, and it positioned itself as India's fintech super app. And it had massive brand recall, huge retail anticipation. So it had kind of set itself up for success in terms of optics when it came to this particular IPO. But Paytm was loss making, and they were still figuring out a clear path to profitability. But still, it was priced very aggressively, and based on future potential, and not exactly current earnings. So the traditional investors kind of questioned where the profits were, what's the defensible moat. but everything was hinged on future growth of this particular company and India's fintech future in general. Now, before the IPO opened, a lot of anchor investors came in, um, and a lot of big names participated, and this created a confidence signal in the market for this particular IPO. But even given the hype, the retail participation was a little underwhelming. NIS was also relatively weak, and although QIBs were still subscribed, the demand was not uniformly strong. Um, and on listing day, it was down 27%, and it didn't do very well. There was a lot of um, issues with the regulators when it came to this particular company, and that just kind of derailed the success of this particular IPO.
So, Kinjal, before you move to the okay, you have LIC here. Great. So, you know, the first two examples which you mentioned, uh, we will not. I and Rupesh will not get into the specifics, but we have led these transactions. So, in our earlier roles, but what we would like to share is the positives here. How this trend set. This was an era where these fintechs were the first ones to come into the capital markets. In fact, when the IPOs hit, we were discussing with SEBI about the how the disclosure framework in the objects chapter. If you open their documents, the first time these kind of objects were drafted, like Zomato's and Paytm's. So a huge amount of back and forth has happened with the regulators that these are new tech companies, though. So the style and the requirements of disclosure needs to change. So that was a very good takeaway. You guys also should look at it. As Kinjal also mentioned, it was a very landmark thing for even India, and we had to align with the global peers. Second, the other key aspect is this also initiated discussions in one of the IPOs. Sorry, will not name them, but the examples only. You guys would have heard about the press note 3, which is like money coming from land borders of India in Indian IPOs. It was restricted. And then it was permissible, or sorry, it was restricted. Restricted in the sense that if it is from any land borders of India, you need RBI approval. So this emanated from one of the IPOs, the examples which you mentioned. So that was the genesis of the entire story, because at that point of time, India wanted to restrict inflows from particular countries which are having or sharing land borders with India. So this is a classic example, because this is how the genesis and the thought process happened. The third thing, uh, in these examples, the first two, three examples which you have mentioned, again, these are long stories. We are not getting into valuation debate and how people have judged. But at the same time, from a regulatory perspective, these are some profound examples. ये बहुत ही अच्छे examples हैं, where you look into it, deep dive, the kind of disclosures have been made. It has been first of its kind. The other thing which regulators have and the bankers on these transactions have also started, इसमें ना blind pool का एक concept जो आपने पहले भी कहीं objects में लिखा है कि अनआइडेंटिफाइड ऑब्जेक्ट्स के लिए पैसा यूज किया जाएगा. क्लासिक एग्जांपल इज पेटीएम. 2021 में ही आईपीओ हुआ था. देयर वाज अराउंड 2000 crores का blind pool. There was no percentage. Today we have a percentage that GCP plus blind pool cannot exceed 35%. Earlier there was no, so it was something around 50 odd some percentages. I think the blind pool was so big enough. Or I don't remember the exact numbers, but that 2000 or 3000 crore war chest was used by Paytm, if you're not wrong, as recent as last year, when the company was in some problems and blah 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 blah. But at least this is the kind of utility which was brought to the capital markets in India. So these were like trendsetters. These two three examples. Okay, valuation expectations and investor expectations, उसमें हम बात नहीं करेंगे, but from a more regulatory concern, these are certain examples, and if you think from, or if you look at those perspectives, these are very landmark examples to have. Sorry, go ahead.
Right. So, basis these kind of landmark examples, then SEBI came out heavier on terms of risk identification, quantification on risk in the offer document, especially when it comes to the Paytm IPO. Uh, and going forward after that, SEBI was way more careful when it came to risks identified for such kind of companies and quantification of and disclosure of such risks. Coming to the LIC IPO in India, it was one of the, again, biggest landmark IPOs. And again, there was a mismatch between the expectation and reality, story, sentiment, timing of this particular IPO. And it was like LIC was India's largest financial institution by reach, and it's a household name trusted across generations. It's a major institutional investor in the market, etc., etc. So it initially had planned to sell 5% stake, raise some 60,000 plus crores at valuation which were extremely high. It was meant to be India's largest ever IPO, a landmark disinvestment by the government, etc. But then there were when LIC, the timing for this IPO was decided, the global markets turned volatile. It was a post-pandemic era, tightening geopolitics was coming into play. Tech stocks were correcting sharply. Investor appetite had weakened at that point in time. And so investors kind of started scrutinizing LIC more closely. And then they were looking into lower margins versus private performance of LIC versus private investors, um, operations, um, government influence, a lot of different things that one looks into while evaluating a particular stock. Um, and then the government chose to resize and reprice the issue. The issue size was reduced from 60,000 crores to 21,000 crore, and valuation was brought down significantly. And this was kind of a strategic compromise to ensure that the subscription was maximized, rather than the IPO being undersubscribed. Um, and when the IPO opened, retail participation was strong because of trust and the discount that was offered on revision of the IPO. And it was on the listing day, it listed slightly below the issue price, but it was not a crash, not a celebration either. But again, LIC as an IPO coming out, one would have expected uh, over average, extremely good response and success for the IPO, but that was not the case essentially. And again, in this particular IPO, there was a policyholder reservation category which was created for, especially for LIC policyholders that received a discount for this particular unique category.
Yeah.
Coming to, if the panelists want to add anything,
Yeah. Sorry. So this is very interesting case study again. We'll not get into the specifics of valuation because Rupesh and I, we were both leading this LIC IPO. So fortunately or unfortunately, the examples which you are quoted here, we have led these transactions. Uh, Again, taking the positives here, the regulatory aspects. Okay, you can just imagine that first era of 2020, that 21, 22. If you see in the span of 6 months, India first time saw issuances to the magnitude of 20,000 odd crores. You know, आप अगर देखेंगे सब लोग कि इंडिया ने कभी इतने बड़े आईपीओस नहीं देखे थे। उसके पहले एक आईपीओस और क्यूआईपीस हुए थे कुछ 8-10 हजार करोड़ के जो हमने किए थे, बट दिस वाज द फर्स्ट टाइम व्हेन इंडिया में एक फ्लड आ रहा था कि इतने बड़े आईपीओस आ रहे थे। सो आई बेग टू डिफर वन थिंग ऑन किंजल, रुपेश यू कैन करेक्ट मी, बट उसमें ना क्या हुआ था कि ये फर्स्ट जब प्लान हुआ था 80,000 करोड़ का आईपीओ था, बट द क्वेश्चन वाज नॉट डिमांड, the question demand means investor demand नहीं था. The question was कि इतनी liquidity है क्या market में कि it can absorb an issue of 80,000 crores. We are not mature enough. That was the biggest challenge. And the government, so DPAM is a apex body under the government Ministry of Commerce में जो ये decide करती है. तो उनके हमने presentation दिए थे कि everyone was very skeptical कि liquidity will be a big challenge. And that was at 21 late 21 22 में ये दो तीन IPOs और भी खुल रहे थे जैसे Paytm of the world. Paytm was what 18,000 crores. This was 22,000 odd crores. So, and given all this, this was the first time which was happening. Those were major concerns rather than not having investor. Frankly, well, at least when we have led this transaction, we can tell you those insights. The other two things which you have already rightly pointed about the policy shareholder reservation. The other key aspects was the mutual fund regulations had to change. So this was the first time it happened in India. Regulation 7B, they are already holding shares, and I'll not get into the detailing. You please refer that regulations. So there were many iterations because when a diligence happens by a merchant banker in these kind of IPOs, a lot of confidential information pertaining to the government of India and the LIC goes in the public. At least the deal team, the lawyers and the bankers. So a lot of regulatory modifications. So when an institution of this caliber or a cadre or which is so close to the government comes in, आप हिंदुस्तान एरोनॉटिक्स के तो उसमें लॉट ऑफ एक्सेप्शंस आर टेकन. अगर आप देखेंगे एलआईसी के केस में द काइंड ऑफ डिस्क्लोजर्स वेदर इट्स ऑन द फाइनेंशियल साइड रेगुलेटरी साइड वो बहुत अलग है. बट दीज आर ऑल एक्सेप्शंस व्हिच वर टेकन फ्रॉम द रेगुलेटर बिकॉज यू कैन नॉट डिस्क्लोज दीज इंफॉर्मेशन इन पब्लिक. So those were largely concerns. I think LIC, that's why it set the trend of insurance company listing in India and its high valuations. So if you would have seen the regulator, even the insurance regulator, उसके बाद में बहुत insurance companies के IPOs हुए हैं after that. But this was the trend setter कि even the insurance company का भी in principle approval लेना पड़ता है तभी SEBI approval देता है. So all these regulatory issues keeping in mind, that was the major takeaways, frankly, in the LIC IPO. Sorry.
In fact, Samir, the most important thing which you missed out is that to build this transaction of which is LIC of India or as a matter of fact Paytm, right? The amount of efforts and amount of the brainstorm that is being made by the banker along with the issuer was phenomenal, right? Because these are the transactions which were built not overnight. It took lot of amount of efforts, lot of change in the regulations, right? Change in the kind of various internal as well as third party regulator because it's a ada sebi, even the internal policies of the government, the company themselves, lot of things that is gone into that, and then after it is been kind of designed and come out with such kind of fundraising because these are not the normal transactions. Tremendous amount of planning and efforts that is gone into these transactions before they actually file the DRHP with SEBI.
Okay. Sorry, Kinjal, go ahead. Please go ahead.
Right. Coming to our next one, which is the Reliance Power IPO. Now, again, this was one of the biggest IPOs at the time. It became one of the most oversubscribed IPOs in India. And 11,700 crores was raised at an issue price of 450 per share. Um, and this the funds were raised to set up 13 power generation projects, and from the proceeds of this IPO, which was mentioned in the prospectus. Now, what happened was that only small fraction of promised capacity was of the power generation projects was actually commissioned. There were multiple project cancellation. It was transferred or restructured, due to which the company did not perform well, and the stock fell from 450 rupees to below 20 rupees at one point. Now, what happened, and SEBI came down heavily when it came to this Anil Ambani group company, where what is the differentiator of when there is a business failure or if there is a diversion of funds where funds were not utilized in the manner that was actually disclosed in the offer document. So SEBI kind of questioned these kind of objects that were actually put into the offer document and whether they were actually achieved or no. So there was, and the argument was that there was a business failure, and which became difficult to prove that the non-achievement of objects which were actually specified in the offer document were actually legal violations, or there were actual genuine difficulty in execution and setting up of these kind of plans. And so yeah, this was again one of the more interesting cases of one of the larger IPOs in India at the time.
In fact, one thing that you missed out, Kinjal, if you recollect, January 2008, where this IPO was highly oversubscribed, I think more than 70 times, and that is also a scale of 11,700 crore, which was one of the largest issue at that point in time. Okay, and that also got oversubscribed by 73 times overall basis. Okay, if you recollect, the same point in time after the subscription of this IPO, there was a subprime crisis happened and all these collapse happened in the Indian and global equity market. Particularly, it was originated from USA, right, which resulted into crash in the market. And because of that, whatever the premium that this issue was commanding at the time of issue period got disappeared, or I would say there was a significant decline. Despite in February 2008, Reliance Power issued 3 bonus shares only to public against every 5 shares held. So virtually, this 450 rupees become a 300 rupees. But that also could not able to, I mean, the market could not able to absorb that free shares as well. Okay, and it resulted into significant loss to the investors. And of course, subsequently, a lot of things that is happened in this company. But eventually, what is important to note is that if there is any trigger or some war kind of situation do occur, naturally there will be a collapse in the what you call artificial or a premium which is getting command or a premium command in any particular transaction, whether it is a IPO, because IPO is something which is a primary price discovery is something which will take its own time to get determined, right? By the end of the day, it's investor who determine this price, correct, which is its own process. For 2 quarters is something which is minimum required for any IPO to have the stable price discovery.
Coming to our next IPO, which is the DLF Limited IPO in
Ru-
2007.
Rupesh, Rupesh, you are absolutely right, actually. In 2008 and 2009, it is not only that, it is actually a global financial crisis which has actually occurred because banks were not able to cope up, other industries were not able to get, money was becoming very scarce. It is actually a global financial crisis because I happened to be in overseas at that particular time. Many people actually curtailed, they shifted, they relocated, they restructured. All the things happen. That is the reason why this has happened, as rightly pointed out by you. That was the case.
Correct.
Yeah. Yes, Kinjal.
Right.
I
In the
think
DLF Limited.
Yeah, Kinjal,
we are.
sorry. I think if these are the last, we are reaching our time
Yeah, it
cutoff.
is.
You want to pick up a few questions so that if it's,
I
do you have more slides?
I think this is the last slide, I believe. Am I correct?
Okay.
There is one NSC IPO, but then we're done. Okay, so in DLF Limited IPO again, there was non-disclosure of certain risk factors that had taken place, omission of such factors in the prospectus that the company failed to disclose. Again, this was a big issue, oversubscribed, India's largest at the time, retail heavy subscription, QIB oversubscribed. So in this case, SEBI penalized former directors and promoters and barred them from capital markets. And it kind of looked into material litigation disclosure and related party transactions with the promoter group, which was not essentially disclosed in the risk factors. After this, SEBI came up with an amendment for defining what materiality would look like when it came to disclosure of litigation um, in the offer document by the company. Coming to the Budhwani IPO fraud, this was actually a fraud that took place where, um, Rupal Bain Panchal and Associates and Purushottam Budhwani opened thousands of fake demat accounts and fake demat and bank accounts and using stolen photos, fictitious identities, and they flooded the IPO applications in the retail quota. They got allotted huge chunks of shares meant for smaller investors, transferred them before listing, and sold them at a premium. Now, when the income tax department raid came in for Budwani, it was found that there were more than 5,000 demat accounts in one person's name. And SEBI estimated that there was some 300 crores in unlawful gains across 21 IPOs that Budwani had, participated in. And so Budhwani was ordered to return some 10 crore and fine 1.5 crore. And because of this particular case, do we today have the kind of KYC norms that we do have, where we have Aadhaar linked DMAT, and you have an ASBA facility that is put in place to ensure that such kind of multiple identities and multiple DMAT accounts aren't used to flood IPOs and derail IPOs. Now, one of the headlines when it comes to the IPO market, which is the NSE IPO, uh, which is the world's busiest derivatives exchange, India's dominant exchange. It actually first filed its DRHP back in December 2016, where it was expected to be one of the more successful IPOs. But this IPO does not bring fresh capital. It's more OFS um, as an issue. But there were a lot of roadblocks that came in. Um, Came in between, where there was an issue of certain brokers being given preferential access to its co-location servers, giving them an added unfair advantage, etc. So SEBI kind of pointed this out and fined NSE with some 624 crore, and the KMPs were personally fined, etc., etc. Um, all of this is going on, and there were some regulatory proceedings, governance concern, complex conflict of interest structure, which kind of delayed the NSE IPO. But now, NSE has received an NOC from SEBI, and uh, they are looking at BRLMs to come out with this particular IPO, which is expected to be a big IPO in the Indian IPO history going forward.
That's all.
That's pretty much it. Yes.
Okay, then we will move on to the questions. I think let me go back. Yeah, I'm starting with Purnima at 11:15. I'm a CS student at our seniors who would be what would be the future capital market in IFSCA?
So I'll just quickly answer this. But yeah, it's a very important position, principal compliance officer. In fact, more regulatory because this is also an SEZ. So this will be very promising as compared to even obviously the market has to grow there, but there's a lot of scope which from a company secretary perspective which can happen.
What is the status of the investor who have not been given the preferential allotment in an IPO bound company, but IPO got delayed due to the current market condition? Should they be refunded?
This is very subjective. It depends on the commercial terms between the investor and the company, frankly. when they invested. It depends on the commercial terms which have been. Sir, I'll pick up one, two questions very interesting and very important, which
Yeah, sure.
I'll just pick up one, two. Rupesh, please add. I think one of the questions someone had asked about UPSI, very interesting question because we don't have an answer even today. Whether insider trading kicks in at the time of DRHP or RHP. Believe me, the entire market, the law firms, the bankers on the street, first we took a very conservative approach of DRHP, but today we have settled in as an RHP because the words used in the regulation are to be listed. So, but again, there's still a thin line which we draw whenever a question comes from a UPI perspective. Obviously, RHP is something which it's nowhere written in the law, but we follow RHP. However, we keep on testing this. It doesn't mean that at the time of DRHP or during this process, we get into some information and do some dealings. As we said earlier, it has to be the ICDRs or these regulations have to be followed in spirit as well. So it's still a dichotomy. So please, happy to have you in this pool of people again now
Yeah.
who are still confused.
So if it is case to case basis, and if there is a breach of trust, or you can say some
Yeah,
gain, it will take a conservative approach.
See,
So
how
correct,
it
sir.
looks is that moment you file the DRHP, then your capital structure is frozen, right? Now,
Mhm.
if there is any change in the capital structure, right, naturally, at what price you are doing the transaction, whether it is primary or secondary, everyone is watching, right? So, from that perspective,
perfect.
just to answer the question, yes, UPSA, even if it is technically not, but in spirit, yes, it will be kind of applicable because SEBI is watching and document is with SEBI or even exchanges, right? Because it is required to be reported also if there is any change in the shareholding or anything like that, because at RHP stage you require to revise it. At that point in time, if there is any question, that no one will jeopardize the entire transaction because of small quantum or some percentage.
Perfectly mentioned. Right.
I wanted to check with the experts on the investment bankers and retail investors likely to show renowned interest in IPO. I've been tracking IPOs regularly, and currently there seems to be limited interest from FIAs and
Yeah.
FOIAs and NIAs. This prevailing government policies and the tax rates also do not appear very supportive for the primary market participants at present. Please share your view on what is when the investor interest in the primary market is likely to revive.
See, this is a skeptical market, but at least the market momentum, what everyone's gauging is very soon the war is settled. There are external dependencies also, right? So, and there is very limited what a government can do in these situations. Unfortunately, there is a war between two nations, and we are getting affected. Who has no role to play in this war? But at least the positive is there is some settlement, and what at least the market is looking at is the momentum should start, though it might be a bit muted. But at least say by next month, you will start seeing a couple of roadshows, a couple of IPOs coming in, and they're testing the market.
No, I think the
Yes.
most important things are is and again just to the audience also, that when after COVID, right, there were 3 years, right, 21, 22, 23, even 24 also, amount of liquidity, left, right, center, all issue got subscribed,
Yeah.
all issue have given a listing gain, and it sustained also. But 2025 and 2026, issue got subscribed. There are multiple transactions and large transactions also do happen. I mean, people have raised capital, right? Uh, but some of the issues have maintained the listing gain or it climbed. But many transactions they could not able to see the light of the day or valuation gone down, right? Because of various reasons. I think most important thing is if you want to invest in a capital market or primary market, you just keep a 3 year horizon, 3 to 4 year horizon, and if you believe in that story, right, then and then only you should invest from a long term perspective. Otherwise, it is like kind of a it's like kind of a what you bolte na, it's a short term momentum. If you see any listing gain momentary, then you participate and you get out. And majority of transaction that whomsoever has put a question, are small transactions or mediocre transactions like that, in such kind of transactions, yes, but interest may come at 100, interest may be at 50 rupees also, 60 rupees also, it depends. But people keep churning their kind of investment, and that is what the market is, right?
Is spillover is allowed in case of the under subscriptions in NIA, RIA, and over subscription in the QIB category?
See, if there is under subscription in QIB category, then spillover from retail and HNI to QIB is not allowed. Otherwise, it's allowed.
Retail portions for the application up to 2 lakh rupees. Is there any difference in the allotment in case of the person applying for one lot and another for the maximum lot? I think this you explained already.
Yeah, 95% of the applications in the market is at a single lot only, right? So if you apply 2 lakhs, then your chances of getting the allotment would be as thin as getting an allotment in 15,000 or maybe lesser than that.
Please also throw some light on the filing of the SSP as per the regulation 31(1)(g), that is 1 day before listing of the share. I think this Kinjal has covered last time.
Procedural,
Actually,
yeah. This is more. No, this is more procedural. Let's.
She already covered in the last session. Who's ever interested, they can see the recording of the last session. It is well covered actually. Yeah, I think UPI question you already answered. DRHP question you already answered.
No,
Corporate
this
governance
question
we
is
talked
different. UPI applicable only for RIIs or also to small NII whose application size is within 5 lakhs.
Okay. Yeah, UPI applicable for RII or also small NIAs whose application size is within 5 lakhs.
Correct. That's correct.
Okay.
It's a mandatory. It's not only applicable. It's a mandatory.
Mandatory thing. Correct.
Does LODD regulation only after the listing happened? That we talked about it.
Yeah.
Regulation 30 material event now to be doubted which event it is material and which is not for the disclosure. That company has to take a call because there is a guidelines have already been issued. SEBI has come out with a circular, but there is a company has to take a call actually on this. Can we get this presentation? We already told in the post also presentation is not shared, but at the same time the recorded webinar is being shared. It is disseminated in the YouTube and she has already given the link here. You can actually access that. As per the section 52 of the Companies Act, there is a restriction to use the securities premium. And how does the companies use the securities premium amount to example in case, for example, Hyundai IPO face value is ₹10 and the issue price is 1960.
No, there is no security premium that is getting accounted in the books of the Hyundai because it was 100% offer for sale.
Correct.
So there is no accounting entry in the books of Hyundai. It's only liquidation of the shares, right?
Right.
It will be accounted in the books of the Hyundai as a kind of shareholder, in the shareholder books, not in the books of company.
मतलब इन्वेस्टर से पैसा सीधा वो जो सेलिंग शेयरहोल्डर उसके अकाउंट में चला गया, कंपनी को कोई फायदा नहीं है इसमें.
Okay. Next question is the PIT regulation. I think that you already. Also, practically, please also give a light on the events of the listing day and the specific of the trading in the share. Since shares starts trading on the trading day, can the preferential promoter groups of the director purchase share directly from the secondary market on the listing day itself? What are the precautions that the company secretary has to take care on the listing day when it comes to the compliance?
Big question, my dear CS.
So basically, if there is any acquisition of shares after listing by promoter or promoter group, naturally required to be, it is a part of insider trading. First of all, second is that takeover code also do apply, and if promoter has to or promoter group has to buy any shares or sell any shares, of course sell is not allowed because it's a locked in. But if it is purchased, then they have to purchase, then they would purchase at the prior to the filing of DRHP. Why now?
Correct. So just to add to Rupesh's point, please you contra trading from an insider trading perspective जो रुपेश ने बोला कि अगर आपने और खास करके if you have done an OFS in the IPO और अभी आप आके मार्केट में खरीद रहे हो, तो how will it look from a contra trade perspective? It should be thought through.
SDD compliance applicable to post listing?
We talked that.
Post listing.
Yes.
How shares are traded in the both stock exchanges, the NSE and BSE. If you want to issue 10 lakh share, how and when to decide which stock exchange gets share listing on the first day? Yeah, it is a choice because you have a choice either to list either this exchange or that exchange, or you can list both the exchanges. It is your choice actually. But only thing is what I understand is one of the exchange, if they think they are actually allowing the permitted trading of the stock, though it is not listed in their exchange. That's what I believe.
No, so I think most important factor, right, just to answer this question, where you see the good amount of liquidity, whether it is BSE or NSE, right? So if the liquidity is there in BSE and NSE both, and if you are giving that flexibility, that is a requirement of the investor practically, not legally. Either of the exchange is okay, but people prefer to list on both the exchange because of the liquidity. Now, if I have to look at two exchange, BSE, NSE is okay. Now there is a suppose third exchange option, which is MCX. If there is no liquidity over there, then naturally that is not a good choice for us or any or investor. I mean, or I would say company.
What is the liability of monitoring agency? The IPO proceed could not be deployed for the objects which is mentioned in the RHP, as you have given one example.
They are a reporting agency, no liability as such. If they are not in knowledge, then there is no liability, but they have to keep on monitoring, like prima facie, their responsibility as more of a gatekeeper here, rather than auditing things. Obviously, they will look at documents. It's not that they'll just blindly look at things, whatever you give. But at least more of a monitoring, a gatekeeping role rather than a fiduciary role.
Will the name of the consultant who support the companies in the process of IPO, including the company secretary, consultant, be disclosed in the offer document, similar to the consultant who supports other areas like restating the financials?
Only name will appear in the document. Other than that, there is no requirement to kind of disclose the details like address, etc.
The company came up with the IPO fund. Yeah. Yes,
Just sorry,
saying,
just to interject. Let's pick up the important ones so that we can have a hard stop. Frankly,
okay.
If you think, what are the difference between? Okay, one of the things which
your
also
voice is cranky.
Between IPO regulations by SEBI and SEC US. What are the difference between IPO regulations by? I don't know how to answer this, but there is a difference of regulars and a 144 offering. इंडियन आईपीओ जो भी मार्केट होते हैं, जितने भी इंडियन आईपीओ होता है मार्केट में, जितने भी मेन बोर्ड की बात कर रहे हैं, whether you can market to US or not.
There is some issue with the
I think
voice.
Samir, it's some issue with the voice, but let me just answer that question. So SEBI is an Indian regulatory body, while SEC, which is Security Exchange Commission, is a US body, right? Both have their own kind of regulations, both kind of own investigation, etc. Right? So we can't compare both this agency, but both are kind of looking into the equity and that kind of instruments.
The regulatory body of different countries, security regulatory body of India and US, we can say that's all.
A company came up with the IPO for some fundraising for an object setting the new manufacturing plants. After IPO, funds are credited. Due to certain government approvals, regulatory reasons, the funds could not be deployed for the stated objectives, what is mentioned in the DRHP, and are held for FDR separately. In this solution, how much max time is allowed? Is within what time years it need to be deployed?
So basically, the timeline for deployment of funds has already been stated or disclosed in the document. If there is any deviation and if it is material, it is a decision of the board and shareholder to decide. If there is, even if there is any change in the objects, you require to give a withdrawal options to the public investors to kind of withdraw their kind of amount if you are not convinced. So withdrawal option also required to be given. So basically, the company, once they raise capital, no, because if given the circumstances and size, and if it is not in the merit or interest of the company, you will see a significant amount of withdrawal, which no company would like to take that kind of risk. So regulation has been designed just to protect the interests of the public investors from that perspective.
Can general corporate purpose 35% or 100%, whichever is lower, be raised to 50% or higher through special resolution route post listing? Is it allowed by SEBI?
I
with
think
the
that
board and shareholder approval, you can do it. But again, it will come with a big risk, which I don't think any company would like to take.
नहीं पर फिर
He's
पोस्ट लिस्टिंग कैसे होगा? पोस्ट लिस्टिंग नहीं होगा ना?
See, change in the objects. See, change in the objects.
Sir,
So,
sorry,
this,
can you please repeat that question?
yeah, it is says that can general corporate purpose, that is 35% or 100 crore, whichever is lower, be raised to 50% or
No,
higher to special resolution route post listing? Is it allowed by SEBI?
no ना रुपेश, ये नहीं होगा ना?
Post issue कहाँ से?
हाँ, पोस्ट इश्यू नहीं हो सकता रुपेश। और ऊपर से ये पहले
Please.
था, you remember? ये पहले था, बाद में तो ये अपना कैप है 25 and 35% का।
no. So, Samir, change in the objects. See, GCP increase is nothing but change in objects, right? So, change in objects is allowed with the board and
Okay,
shareholder
वैसे
approval.
अगर हाँ, yes, plain vanilla reading, yes, agree what you're saying.
And you
And
have to give a withdrawal option also.
नहीं, but GCP cannot go above 25 ना?
That is fine. That is fine. But still, again, it's a change in the objects, right?
Objects.
Yeah.
Yeah,
next
correct.
is what
Objects. Correct.
So it is allowed.
somebody
No, sir.
says
No,
in
it's a very tricky thing. Because it's better to go case by case.
Okay.
Then you are violating ICD of the spirit, right? It should not breach 25 and 35%. But yes, what Rupesh is saying from a just a variation of objects, but उसमें आपने लिखा है कि हम ऐसा distort कर सकते हैं. It is a very tricky thing. It demands the merit to understand the merit of the case and then only take a decision.
Absolutely.
How regulator will take it?
Yeah.
So it's a risky thing. Basically, regulation is designed to protect the interest of the public. So if
Exactly.
any decision which is not in the interest of public, it will have a cascading effect,
Yeah.
in temporary FDRS, I don't know what is this question actually.
Fixed
Because
deposit,
of-
they say.
Yeah.
FD, basically.
Yeah. What Somnath wants to ask in temporary FDRS? I don't
No,
know.
he has just left the question. Take
Okay.
straight away.
Okay.
Next time.
Okay. In financial year 25-26, the IPO boom, many are set overvaluation of the few companies. Is there any regulation to set to doing valuation of the IPO? Is it not then why SEBI has not come with such regulations? With your view on this?
I think, sir, the answer is very simple. In the world, not in India only, in the world, no regulatory body could able to decide the valuations or valuation parameter. Correct? Because I mean, everything is a future, right? In future, like for example, Elon Musk, he may have a certain thought, right? But if he implements successfully, then the valuation could be 20x. But if he does not, then the valuation could be zero also, right? So it's very difficult with AI, right? Artificial intelligence. There are a lot of tech companies, there are a lot of future businesses, right? Where you see the future today, but everyone cannot see the future today. I think when Zomato acquired Blinkit, there were a lot of ruckus that it was acquired at a very high valuation, etc. But where today? What the promoter thought 3 years before, or management thought 3 years before, and you are seeing the fruits today, right? It's a totally different thing. So I don't think any regulator, even today or in future, also take any steps. Only thing which can be done by the regulator is monitor. You set up a surveillance, you set up a heavy penalty, etc., which any, I think all the countries or even our regulator, which is SEBI, they are doing it fabulously. Maybe it may not be 100%, but to a great extent, the kind of mechanism is there. I mean to say.
Yeah.
you're
Do informally check with us about how did you arrive at a valuation? But
Yeah.
it's more of an informal check, no regulations and all.
why anchor investors are not been decided by the BRLM? Is there any particular reasons? And does the company board is also involved in that or not?
Yeah, it's a discretion of the company and the BRLMs. Discretion hai. So
In case
It
of
is
the
a flexibility that has been given because how it works is that if any long-term investor, you will not refuse a long-term investor not to give any allotment to that particular investor, right?
In case of the subsidiary of a listed company proposing to get listed, how to handle the disclosure of UPSA relating to the listed company and might have the bearing on the subsidiary? How to handle this issue?
Again, it's a
very You
You
cannot
have
answer
to adhere to the laws,
short
right?
switch. Yeah.
No, no, in fact, the regulator has given a very guidelines on this. You need to have the insider trading code put in place,
Yeah.
and only the information need to be shared. Only need to know. Otherwise, it is not. There should be a stricter monitoring. Will be required. Actually, whatever it is, whether it is subsidiary or listing,
No, sir.
whatever it is.
So, Bala sir, we understood the question very well because, and we cannot answer in a very small. Just for an example, what happens is, कि you for a unlisted holding company, you need to come out with consolidated results, and if the subsidiaries are listed entity, so there is a timing mismatch between the declaration of financial results and when you're going in the market. So there are certain nuances we cannot, just simply answer this in a very short. Unfortunately, but it's a very good question. Uh, it will take some time. Frankly, we cannot answer this in a short 1 minute discussion. But
So I think Samir, what you given an example is a correct one. So suppose a holding company required to disclose a result for a to be listed subsidiary, right?
yeah,
Then you can do the consolidation. You can share those information, no problem. But there is a restriction on scheduling an analyst call and talk about the subsidiaries company's business in detail, right? So analyst
correct,
call, you
correct.
have to restrict and limit your conversations to a great extent and not to reveal something rosy picture about a subsidiary company. You have to remain silent.
Yeah,
How is the
and
I mean
see, there are
during
ring
those
fences. There are
period,
many
yes,
ring
till the
fences.
time of listing,
Yeah,
yes.
there are many ring fences which need to be done. It cannot be answered so simply and straightforward. कि आप कर सकेंगे. But let's move on to the next question. Sorry.
Yeah, how is the liability of the different third parties in the IPO
It's too
alignment?
big,
That is
Mr. Bala. We can't take this. One, two,
okay.
three, four, five. It's a very big
Okay.
thing.
Okay. Usually in the IPO, companies actually tended to restructure the figures in their financial statement to show positive side of the company. How to understand whether it is genuine or the retail investors?
Again, this is
Diligence.
something which is
No,
see,
no. Yeah.
how
Go
it works
next.
is that you read the disclosure, you read the MD&A, right? Now, end of the day, the numbers is something which is audited by the auditor. Now, something which is been done incorrectly or not in line with the kind of actual thing, that is something which is a big question mark. Then it questions the diligence basically, right, of the company. See what happens many times when you are private, no, you do a lot of things, right? You just put a lot of salary, and again within the four corner of law. I'm not saying anything which is outside that four corner of law. You put a give the remuneration to promoter, which is like a 1 crore, 2 crore, something. But when you come out with IPO, no, you rationalize everything, right, based on the diligence and all. You draw a limited kind of contributions, managerial remunerations or something, right? A lot of alignment that you do during that period, related party, arms lengths, all those transactions you restrict and you do it within the compliances of applicable law. And because of that, there could be an improvement, there could be a good intent, etc. A lot of things that do come into the picture, right? uh, yes, it is a genuine thing that okay, the public may feel that okay, this is something which is rosy picture all of a sudden that is being showcased, but it's a valid diligence point. We always kind of guide company to be realistic much ahead of the IPO. Like if you have to do the IPO today, we guide that company 1.5 2 years back, and then after we come into the picture and be in front of the investor. Till the time it is a question mark, yes.
Why small investors were refunded in full in LG issue?
Uh, I think now it is very common questions. I think so. What are the key difference between IPO regulated by SEBI and SES US? We cannot mention this in the webinar. What is the difference? Then next was what are the most common red flags that lead to SEBI issuing observation delays, seeking clarification in DRHP, increasing post-listing volatility? Is there any Yeah, you can read, and if you want to give some observation or your comment.
See, the
Because
post issue volatility now is not something which is in anyone's hand, right? It's
yeah,
about the quality of investors. If there are long term investors, then there will be less volatility. If there are short term investors participating in the IPO, then there is a high volatility.
In fact, I have seen there are a lot of people who actually participate in the IPO the day of the listing when the issue opens up. They immediately encash it, they get out of it looking for the short term. If that sort of the things happens, yes, this are bound to happen. Volatility will bound to happen that way.
what
What are
are
the
the
most
key pitfalls companies face in drafting objects of the issue, especially where the funds are allocated for general corporate purpose?
See,
I don't know how
one
to
of the
answer this.
criteria. See, one of the criteria, ma'am, I'll tell you. So, if you have earmarked the funds for the purpose of capex, working capital,
No,
or
Rupesh,
say,
DCP. He is asking DCP, specifically DCP. What are the pitfalls of we have to be in mind drafting the GCP? So it should not एक मुझे एक ही एकदम immediately ध्यान आ रहा है to cut it short कि भाई it should not be repetitive. If you have covered in other objects, तो ये objects में नहीं repetition नहीं हो सकता खत्म. Let's move ahead.
Yeah. Okay.
What future you see about the MCX?
no comments. I think it's
Yeah.
again a listed company.
Okay,
It's
I
doing
think
great.
I
Yes.
think it's over.
I think I am done with it. Somebody has put a question. Shall we get the part 1 and part 2 of the webinar? Part 1 is already distributed. It's available in the YouTube. Part 2 will be disseminated immediately after the compilation. In about 2-3 days time, it will be available to you. Yeah.
Yes. Thank you.
Happy to get questions separately. So sorry, but it's better. Need to step out. We have
Your voice is breaking.
Sure. I think, sir, thank you very much for inviting us and be a part of this seminar. Thank you very much. We are happy to take up more questions or anything. Please do email it to us. Whatever that you receive from all your audience, etc. We are happy to respond that as well. Not an
Yeah.
issue.
And
There are two people who have risen the hands. Would you like to have a time
yes,
to listen
yes,
to them?
Yes.
Yes, Raj Garg and Hans Raj. Can you unmute yourself? You speak, please. Raj Garg and Hans Raj. Are you
Hello?
there?
Hello.
Yeah. Yes, please.
Yeah. Am I audible, sir?
Yes.
Yeah, very, very much.
Yeah. Thanks all the dignitaries on today's webinar, for this insightful session. And special thanks to Rupesh ji and Samir ji for, taking out time, definitely. So my question goes back to the same thing, sir. Actually, in terms of the trading on the listing day, actually what I meant was more specifically, of course, I understand that the DPs, as per the PIT, of course, they are restricted on trading. If the listing is happening during the trading window closure and the contracted restrictions and all that. Because it so happens, because on the listing day, there are few promoters or the directors who tends to purchase securities through the promoter group entities or the entities which are not falling under the DP definition. So it so happens, the DPs who are not restricted by the trading window closure restrictions or, the PIT, this thing, as per the designated person definition. So it tends to happen, promoter tries to purchase or the director wants to purchase shares in the open market on the day of the listing through the entities which are not covered under the DP definition, basically. So I was just trying to understand that aspect as well, in terms of, because if they want to purchase substantial quantity from the open market, secondary market. So I was, trying to inclinate towards that aspect, actually, as per the compliance.
So basically, let me just answer very shortly.
Yes,
okay. Sir. If you do something which is not in spirit, right, or which is not
Correct.
within the four corner of law,
correct,
you are subject to penalty, prosecution, all these things, right? I think I'll just limit my answer to that extent. Only thing is that the moment it gets proved,
Correct.
right, there is an insider, directly or indirectly, correct?
Correct, sir.
You are subject to penalties and all that stuff.
Not only that, inside trading regulation attract.
चोर पकड़ा गया तो चोरी कहलाई जाएगी. That's how it works. Okay.
Insider trading regulations are severe. Penalty will be amounting to number of the gains what you have made, multiples of that will happen actually. And I think being a company secretary, he has to take care and implement fully the insider trading code within the company. It is his duty also to monitor and report from time to time to the board of directors.
Such kind of things do occur, or such kind of instances do come out not immediately. You will see such kind of instances after 3 or 4 year or 5 year. Okay, so when we say that it's a secret, nothing is secret.
Correct.
Yeah, you're actually right. So long as no regulator has come back, you are safe. The moment regulator comes up, you are in serious problem. That's it.
Understood, sir. Understood.
So you should stay away from such kind of.
Or Hansa, just to 2 cents here. तो अगर insider trading regulations है ना, उसमें एक बहुत ही अच्छा word है rebuttal. This entire regulation insider trading is on a rebuttal presumption.
Correct.
So मतलब the other.
That is all, I think.
Yeah.
Dipti, your hand is risen. You want to ask
Oh, sorry.
something?
No.
Yeah, that is all, I think. I don't see any other hands is risen. I think we
Okay.
already answered all the questions. So we already answered to the people also. Yeah.
Thank you.
Thank
So I
you.
can
Thank you, ma'am. Thank you, sir. Thank you, everyone.
Thank you,
So,
everyone.
Thank you, Mr.
Samir,
Samir. Thank you, Mr. Rupesh. Thanks a lot for your time and sharing your practical aspect. People has benefited. Thanks a lot. Thank you, Kinjan. Thank you, Mr. Bala. Thanks, everyone.
Thank you, sir.
Samir
Thank
and
you, sir.
Rupesh, it is very great to hear from you, especially from the practical aspects of you and other thing and all. It keeps really enriching our knowledge. I am personally many thankful to you. Same will be with the case with our participants also. I am very sure about it. Kinjal, you have put it everything very nicely as usual. Without any saying further, I say simply great. You have done a good job.
Thank you.
Thank you.
Thank
Thank you.
you. Thank you, ma'am.
Thank you, everyone.
Thank you.
Nice looking.